welcome to the FII View with me, Tanveer Gill. My guest on the show today is Marsha Gordon, Head of Emerging Market Equities at PIMCO. Now, prior to joining PIMCO in September 2010, Marsha was a Managing Director and Head of Global Emerging Markets Equity Strategy at Goldman Sachs Asset Management. In total, she helped oversee more than $8 billion in total assets. Marsha, it's so good to have you on the show. Thanks very much for taking out the time. I want to begin by asking your view on emerging markets. Now, within PIMCO, and within your funds, are you experiencing outflows from EM dedicated products and inflows into DM funds? What has been your experience broadly with money allocation trends across asset classes? Are investors getting more and more convinced about the U.S. recovery, you think?
Well, our equity business is growing, and we have not had the same prominent effect of the switchover from the developed market equities into EM equities as have been seen elsewhere in the fund flow data. However, clearly the U.S. growth has been showing leadership. EM has been going through a number of transitional issues, and that manifests itself in shifting investor interest.
Marsha, what assumptions are you making on the Fed's proposed actions over the next 6 months and how that may impact EM investments?
Well, clearly, the level of rates that we have seen at the beginning of the year has been very, very low, and it was logical to expect some gradual rise in expectations as we have witnessed in May and June. We view the tapering as something that will happen over 18 to 24 months basis. Clearly, markets could fast forward that. Any talk of tapering, particularly if it becomes disorderly because of the number of carry trades that may have been put on in the market, could have a pretty negative impact on the dynamics of flows in EM. And if you were to take some emerging market countries like Turkey, like Indonesia, that had a number of macro imbalances and have been dependent on the fixed income, foreign fixed income flows in financing the deficits, those countries are clearly becoming very vulnerable. Now, a lot of that has been factored in by pretty violent market reaction there. We've seen the EM currencies weakening pretty rapidly in the second quarter. So I would argue that the markets have positioned themselves for gradual tapering, and now all eyes will be on whether there is a handover between financial assisted growth and the genuine self-perpetuating growth in the United States and elsewhere in the world.
All right, at PIMCO, the long-term view is that we could enter into recession again over the next 5 years. Where are you placing your investment calls given that broad view?
Well, look, that view is predicated on a number of unresolved structural issues. We are not out of the woods in Europe. Look, last year it was Greece. This year it's Portugal. Clearly we have a number of demographic issues as well as issues of leverage that are very much unresolved. So a recession is not out of a realm of possibilities over the next 5 years. So what do? It's more a question of what you don't own. You probably don't own mispriced credit. You do not own mispriced, richly priced high yield. So it is a question of moderating your positions in areas that are vulnerable relative to what default risk the price may be factoring in.
Of course, a key factor for you is managing the currency risk. Has that impacted your returns?
Well, we manage well over $2 billion in our EM equity product, and clearly we have ample room to hedge currencies. Currency markets are very, very liquid, and we pare down or pare back any active currency views, provided it's not prohibitive. With the stronger U.S. growth, with now treasuries yielding higher level, particularly in comparison to, say, Japan, U.S. dollar is likely to remain strong. And this is a negative backdrop for a number of EM currencies, particularly the ones that I referenced, the Turkish liras, Indonesia's rupee, Indian rupee, etc.
Marsha, in a market like this, which is fairly volatile, have you increased your allocations on cash or increased, your hedging strategies with taking more option positions, bought dollars perhaps to mitigate the currency risk and the sell-off that we are seeing in emerging markets?
I wouldn't call it a mitigation of the currency risk because we can do it through a forward instruments or other currency positions. But I would say that we have taken money off the table in April and May in a number of stocks, say in Indonesia, where we felt that the risk reward wasn't very attractive, particularly given a potential for a withdrawal of funds in the fixed income market that in fact then triggered equity retracement.
Also, Masha, how much of the EM trade is moving towards investing in U.S. or European companies having EM exposure, basically invest in funds having exposure to MNCs expanding into emerging markets?
Well, I hardly think it's a new topic, and it's rather an issue of sectors, versus domiciles. As you know, we in our fund can invest pretty broadly around the world. We have 20% of our fund in developed market companies with a strong EM DNA. That allows us to, say, go to Japan very early, prior to, say, Abenomics, taking full speed. Our philosophy is find the very, very best companies with right EM DNA at an interesting risk return. Now, if you were to reference EM companies versus DM peers, again, I think it's a question of sectors. Take staples. EM staple companies are highly rated. You would never know that, Godrej, was listed in India versus being listed in the United States, right? So staples as a group globally has re-rated. Energy, take, the cheapest sector in EM, energy is the cheapest sector globally. So energy sectorally has derated big time as well. So I think it is a question of sector selection and stock selection rather than domiciles.
Masha, all EM currencies have fallen significantly, and that's a big talking point. How do you view this fall? In India especially, policymakers are very worried about the fall in the rupee, even though it's a larger EM issue. What's the view that you're taking on EM currencies as of now?
We have referenced in prior answers the question of a stronger U.S. dollar, a more robust dynamics within the U.S. Clearly puts the EM currencies on the weaker footing. Add to that the issues of middle income transition, of structural reform that are actually taking place in EMs, but mean softer growth. This is clearly not positive medium term for EM currencies. So rupee is not alone, as you say, in this game. It is RBI is in a very difficult position. It can take some incremental measures. But this is very much tinkering on the margin. RBI cannot hike rates in the face of pretty anemic growth, and effectively we need to see the weakening of the rupee as a way of macro adjustment. So for me, it's the return of EM growth, that season of leadership from the U.S., which is unlikely in the near term. When that happens, EM currencies will find firmer footing.
Also, just wanted your view on gold. What's the call on the yellow metal? What's the kind of range that you see there?
Well, look, I think gold is a very emotional matter. We have never had gold positions in our fund. We've had some exposure to gold equities, and that's been clearly a very, very disappointing trade. We are out of the equities for the past year. With more talk of Fed tapering, gold loses its appeal of money printing. So you need to see a decisive return back of inflation, I think, to reignite the investor interest in gold. Now, consumer may be a different matter, but both economies of China and India, some of the larger consumers in the world, those economies are not doing as well as they did, say, in 07, 08, or as late as 9 or 10. So therefore, I think that on the margin, consumer is also likely to remain a cautious buyer rather than view it as a strong avenue for or strong destination for savings.
Masha, you have your ear to the ground. So how much of the data that's coming out of the U.S. is signaling a possible recovery and perhaps a growth of above 2% for 2013, you think?
Well, look, the unemployment data has been good but not terrific. The housing data has been strong, so I think that the The hope may be that that housing recovery, leads consumer recovery and leads the significant job recovery. I think we are of a view that the recovery will be moderate. But again, it is very much boiling down to consumer. Consumer has repaired its balance sheet somewhat since the peak of indebtedness in 2008, 2009. And therefore, again, if the animal spirits take hold, you could see consumers starting to re-gear, and that potentially could have a positive impact on U.S. growth.
Marsha, let's talk about India and China. Are you reevaluating your view on China now? What do you make of the credit concerns in the region?
Well, look, we remain very concerned about the developments on the liquidity front in China. We think that PBOC may have been too laid back in its response to the liquidity squeeze, which is it now trying to remedy. And clearly, if you were to look at the public accounts of the banks, of the publicly listed banks, those banks tend to show 1 percentage points of NPLs. Now, to me, this is bordering on being ridiculous. So clearly, there is a problem of non-performing loans. Now, China benefits from being a closed capital account economy. It's difficult to see how a large-scale crisis could be triggered given ample resources, but what is clear is that that type of credit squeeze, liquidity squeeze, will have an impact on growth. So we were early with our views that Chinese growth is unlikely to hit an optimistic plank of 8%. We are of the view that growth will slow down towards 6.5% mark. And that will continue being an overhang for China assets.
Recently China suspended release of its PMI data. There has been talk about the data not being accurate. Does that make you more cautious as an investor?
I think the investor community have always taken the data with a grain of salt. In the years of 10% growth, the rumor mill had the growth at 12 to 14%, and clearly in the years of lower growth, the growth may indeed have been lower. So it's good that the government is addressing the issue of the sanctity of data. And I think that this will do little negative damage for the investor views, again, because we've always thought that data has been calculated, with a certain margin of error. And I repeat, it's good that the government is addressing the issue, and hopefully we'll have more robust data series going forward.
What about Russia and Brazil? Because you have more exposure to those regions compared to India. Do those stories, which are largely commodity linked, convince you more than the India story at this point?
Look, Russia and Brazil have derated hugely. Russia is trading now at PE of 5. Brazil is trading at a PE of 7 or 8 times. So clearly very cheap markets, very, very different markets from India, commodity dominated, pro-cyclical. So one has to be a stock picker in those markets to make the numbers work. All of that said, some valuations in Russia have reached absurd levels. So if you take a bellwether stock, Gazprom, it trades at 2.5 times PE, yielding 7%, and with a price to book of 0.2 times. Very cheap indeed. And at some point, when the valuations become absurd, you could see the Russia becoming a recipient of fund flows as a safer place with a bigger margin of safety. We started to see some of that happening over the past few weeks. It's very much still a question mark whether the trend persists. But what surely unites all the BRICS is the political risk, policy-making risk, and that has taken a very, very violent toll on the markets over the past year.
Marsha, I've interviewed you a couple of times in the past, and you've been underweight on India for a while now. Has the risk of India as a market gone up or down for you over the last 6 months? And how do you foresee risk-adjusted returns for India over the next 6 months, the second half of this calendar year?
We have closed somewhat our underweight through the purchase of banks, private sector banks. We use the market weakness as times to accumulate. We do think that private sector banks are well positioned to eventually benefit from a pickup in investment growth. Again, we do not think that India growth story is broken. It needs time. And clearly the biggest worry for us has been currency. India, unfortunately, doesn't have huge elasticity of exports to currency, nor the elasticity of diminishing imports. So, unfortunately, weakening rupee is not having as much of a beneficial effect as it would, say, in a commodity-producing nation. So we continue to look for opportunities. Again, we wouldn't buy India Inc. Wholesale, but we do think that the market sell-offs provide attractive entry points in a number of securities that still stand for secular growth.
You know, the range for the Indian market, Masha, has been a broad one between 5,500 to 6,100. Is that range going to be a mark for the next 6 to 12 months, or you think things can change where the market can break out of this range? Is that a possibility that you're working with? And how are you factoring in or accounting for political uncertainty into your India view?
It's difficult to see the market breaking without rupee stabilization. Look, foreign investors ultimately are dollar investors, and having lost some 10% this year in currency devaluation, would make anyone pause. Now, the good news is currency is much weaker. The question mark remains: when would investor community feel that the fundamentals match the price? And again, I think it's a question mark of the resumption of growth, resumption of investment activity, and more structural measures being put through. But again, we should not lose the sight of the things that have been done by the finance ministry, and a number of structural reforms in FDI, in telcos, in retail that have been championed in a relatively short period of time. So should that pace of structural reforms continue and elections, so to speak, be done with, I think Indian markets have a good chance of breaking out.
Masha, while I've asked you this earlier, I just want your specific view on the rupee and the fall that we're seeing in the currency, and what do you hope to see on the macro front in India?
Again, the fall in the rupee is very much a function of stronger U.S. dollar. With the move in treasuries, U.S. dollar yields, quite attractively relative to the remainder of the EM universe. EMs have been a source of the carry trade. Cheap financing clearly allowed multiple leverage there, and we've seen the unwind of that trade. Again, hopefully the yields that are now pretty compelling in emerging universe, coupled with structural reform and pristine policy making, could help stabilize certain EM currencies. So we are perhaps more positive on, say, Mexican peso versus Brazilian real. But again, it is very much also the function of the strength of the U.S. dollar.
Masha, there has been a fair amount of interest in financials in India, purely on the back of the new banking licenses which will be given out. How do you view the opportunity for companies, especially like a Bajaj Finserv, which have a robust business model in insurance already? As an investor, does it create a value opportunity for you, especially for those companies who will manage to get licenses?
Clearly, licenses make these franchises more robust because they add an ability for the franchise to do deposit gathering and to retain and obtain a cheaper source of long-term money. So it will be a positive. Should that happen, again, this process has been pretty lengthy, so we need to see the decisive resolution. But clearly, when you think about the model, the resilience of the franchise with an ability to raise long-term money, you are adding very much the resilience to that franchise.
Moving on to telecom. Now, some believe that telecom is perhaps at a turning point in India. Do you agree with that view?
Look, we think that the market is still fairly unconsolidated, and that's unfortunately something that puts this market or sets that market aside from our more favored markets. We are not currently investing in Indian telcos. We found better value in a way of combination of growth plus dividend yield in countries such as Kazakhstan, Russia, South Africa, where we can find yields between 7 to 13% in the franchises that are still growing. India will become attractive once that consolidation takes place. Perhaps the FDI bill could be a step forward, but until then, it will be very much a question of competitive pressures, and it's more difficult to predict how these pressures evolve in the market that has 4 to 5 players versus having 3 players.
Masha, there is pressure on state-owned banks in India to cut lending rates, the whole process of transmission essentially. The stocks have fallen here. Do you still see value or the trade largely being with private banks, or is value emerging in PSU banks?
Value is abandoned in state-owned enterprises across emerging markets. Those companies, and I referenced Gazprom a few minutes ago, those companies have derated to multiples they've rarely traded on. But this is not to say that this would be winning investments over the next 3 to 5 years. It all very much depends on the degree the state uses these companies as a supplement or as a tool for stimulating growth. We are not very hopeful on that front, and particularly in institutions that are levered, that have capital adequacy requirements. That type of game is very dangerous indeed. In the meantime, clearly, private sector banks are more expensive, but think about the compounding effect. If you can avoid the landmine of NPLs, the compounding of the book value through the profit accretion is very powerful. So I would not be going for value within financials, particularly when the growth trajectory still remains quite uncertain.
Masha, with the gas price hike that's come by, despite some controversy here and there has been a changed view on Reliance Industries and ONGC. Are you looking at these stocks and perhaps the entire energy space favorably now?
Sure, this is a big deal, and again, this is a big deal not just in India. We've seen, interestingly, a similar deregulation happening in China at the same time. For us, it's a question of price. We currently do not own Reliance Industries or ONGC for that matter, because again, we have been able to find better alternatives in the global energy space. But it's certainly and surely a step in the right direction because it allows companies to accelerate the investment growth. I've seen some reports of Reliance becoming a big player in shale. Again, the economics needs to work here, but this is clearly a very positive thing for a potential for re-rating of the stocks in the energy stable.
Well, thanks very much, Masha, for joining us and giving us your views. Really appreciate your time this week. With that, we come to the end of this edition of the FII View. Catch you with another special guest next week. Till then, take care.